Good morning, good afternoon, good evening, traders from across the globe. Welcome to Short-Term Trading Live with Oscar's weekend webinar. Traders, have you read the papers this weekend? Let's start off with fundamentals. We'll start off right here. 533,000 jobs lost last month, traders. The lowest rate since 1974, or I should say the highest jump of unemployed since 1974. Now, I want to show you very quickly a chart of what happened back in 1974. Mike, do me a favor, get a close-up of this chart behind me. Traders, you are looking at the Dow Jones Industrial Average Daily Bar, 1973 to 1974. This is 1973. Look at the bear market we went into. 1974, this is Dees of 73. 1974, we go into a complete flat. Now, this is where the unemployment is now today. So we had the bear market already. We had the bear market in 73. We had our bear market now. Then we go into 74. Jan 74 goes into a flat all the way out until about August, September. Then let me show you what else happens between 73, 4, and 5 during that really bad bear market that we had, which equals the unemployment rate that we see today. Okay, traders, very same chart. After the flat, another wave came, a big wave, big, huge wave, and then finally in 75, we went into a bull market. So you had the bear market all throughout the end of 73, most of 73 throughout the end of 73. Then you went on a flat through 74, and towards the end of 74, this is August, you started the next wave. And boy, oh boy, was it ugly. And finally, that was considered capitulation, and we went back up. Now, that's 73, 74, 75, and it matches the unemployment level that we're seeing now. Let's talk more, traders. All right, traders, so you've seen that chart, right? So the unemployment in 74 looked like it does today, and the market looked like that. That was really big and really ugly, but we did go into that flat for a while, and then the next wave was coming. Now let's continue to talk about unemployment. Lots of fundamentals, right? The last unemployment report was 284,000 lost jobs, which they revised to 403,000. From 284 to 403, that's the revision. That's 119,000 more lost jobs on that revision. So if we got 533,000 for last month, that means they're going to revise it to somewhere between 700,000 and 800,000 jobs. That takes us over 1.5 million jobs since September. Now that gives us an unemployment rate of 6.7% now without the revision. You know what, traders? After doing enough studies this weekend, I realized that the federal government has two ways of looking at unemployment. They had the people actively looking for jobs right now who are unemployed. Then there's the people who stop looking for jobs. When you throw them in, and that's most likely the ones that ran out of unemployment benefits or just flat gave up because there's nothing in their industry. If you add them in, unemployment right now stands at 12.5%, traders. Do your homework. Another wave has to be coming. But we're talking fundamentals right now. Retailers, the retail sales, the worst report since 1969 came out. That is 40 years. It's the worst report in 40 years. But we're talking fundamentals. So what else do you have? You have crude oil. The crude, as you know, I think, was the catalyst that broke the economy's backs around the globe, right? Well, crude oil's come all the way down to $40 a barrel. That is going to help this market. It's going to help to reprice the market a little bit. There has to be a repricing of market value because crude, if you think about it, energy, every single company in the world uses energy for something, and everybody who goes to buy those companies' products uses some kind of energy to get there. So if the cost of energy comes down, the shipping sector does better, people going to the gas stations do better. So there is that shining spot, right? So that should give us a repricing that maybe will take us up a little, but another wave has to be coming. Let's talk about that. Right now we're talking good news, right? There's not much, but you got the crude oil. You have another $700 billion package Obama wants to put out there, another stimulus package. Where's that money coming from? Who's paying for that? Even if he does it, another wave still has to be coming, traders. You have massive currency depreciations around the globe. Now, you have the Detroit 3 big, right? They're looking for a bailout. Even if they get the bailout, people are saying, Oscar, is that going to give us a rally? For what, traders? Who's going to buy the cars? Either the unemployed or the people who lost their pensions across this globe. Are they buying the cars? Are car rental companies buying cars? Not a chance. Is the trucking industry buying more? Not right now. The list goes on and on. So if you get a rally based on the big three getting bailed out, what does it mean? Who's buying their cars, traders? That's going to be throwing good money after bad. If we give them billions now, what do they do in March? They're going to ask for more billions. That is just money literally being thrown into a fire. So bailing them out, even if it gave you a rally, and even if the Fed thought it was sensible to bail them out, which I don't really think it is, I think it's sensible to help them go into possibly a bankruptcy protection stance where they get to say to their creditors, sorry, we're off the hook with you guys. We're going to keep our people employed and we're going to go forward from here. And then the Fed help them. Maybe that makes sense. For the Fed to go, here's a few more dollars to live on till you go broke next month. I mean, come on. We're talking billions and billions, not $10 here. So you have these fundamentals coming out of the woodwork, right? Fundamentals. Well, you know what, traders? Who cares about fundamentals? We have technical analysis. That's what this is all about. That's what I'm all about. Fundamentals always come out in the charts first. So if you think this first segment sounded confusing, of course it does. You got good news, mostly bad news, but possibly good news. Who cares? That comes out in the charts first. Now, let's talk about trading in December, traders. Here we go. The specs are in control in December because most hedge funds are already closed up. Hedge funds close their books basically right around Thanksgiving weekend, and they are done. The big meat traders, the big-size traders, they're done. They're out right now. They're on the sidelines waiting until Jan. So the specs are in control. Beam me up, Scotty. Look out. We got the specs playing all through December. Specs are gut feeling, seat of the pants, usually emotionally driven traders. They are at the helm. Oh my goodness, are we going to have a tough time? I'll tell you right now, technical analysis is more important now than any other month this year or any year. I have shown you what happens around holidays, right? I gave you that whole illustration, what happens for October, for the Thanksgiving holiday weekend, and it came true exactly as we thought. Well, the month of December, starting the second week into December, the whole rest of the month acts very much like the markets did during the holiday. However, you still had some funds in during the holiday, so that nice run wasn't bad. The funds are done. They're out. And I'm telling you, this is a speculator's game for the month of December. And when specs get involved, this thing goes up, it goes down, it goes sideways, it goes places it should never go. So let me tell you something. There is no way it's going to be easy for the next couple of weeks, so you really, really need to rely on your technical analysis. With that in mind, traders, back here on the board, once again, if you remember, I showed you the head and shoulders, the parallel, the head and shoulders, the parallel, the head and shoulders, the parallel. You know what we did last week, traders? Every day last week, we stayed right inside that parallel. And if you remember, I drew this parallel before it ever existed, just copying what I've seen in the past. We stayed in it. What happened on Friday is we popped up just above it. And I'll tell you what, you look at the charts at first glance, I'm human like the rest of you guys, right? The rest of you traders. I looked at the charts and the first thing I said was, wow, does that look like a buy? But that's an emotionally driven idea, an emotionally driven trade had I accepted it. So of course what I did, I hit the books, I went and did homework for hours on end, I read all the papers, then I did more homework, then I got up Sunday and did even more homework, and here I am now to show you what I have found. I'm going to tell you right now, don't fall in love with the upside, and there is a good reason. This is the weekend webinar for Sunday, 12/07/08. We're heading into the second week of December, traders. I'm telling you, you're going to need your analysis here. Let's go look at some charts so I can show you what I'm talking about. Okay, traders, what we're looking at now is the S&P December daily bar. You've seen this chart before. This is what was drawn on my whiteboard a moment ago. I just wanted you to take a look at it up close for yourself. We stayed in the parallel here, made the inverted, stayed in the parallel, made the inverted, and stayed in the parallel channel all week last week, traders. That is bang-up analysis. I don't care if we traded it right or wrong. The fact that it stayed in there is pretty bang-up analysis, right? Well, it just peeked its ugly head up right here on Friday, and you would think, wow, that looks like a buy, right? You hear all the buy talk. Everybody's getting buy crazy on Friday. You heard that. You seen it. Well, let's go look a little more deeply into these charts before we just run out there and buy anything, traders. Let's look at the next series of charts, right? I think you're going to like what you see here. Okay, traders, the last chart you just seen was looking at the trees very up close, the way we trade with day traders, with short-term traders. This chart is more or less opening up the forest a little bit, a bird's eye view, a larger view of what's going on. We have another, it's a debut, I haven't shown this one before. It's another one of the Omni's proprietary moving averages. It's this black average right here. Take a look at the respect the S&P has paid to this average all through here. It got up here just a little, could not maintain here, here, and here. This market has stayed below this average all the way down. Then we put it on head and shoulders, had a drop, and now we have a diamond formation, traders. A diamond formation is a very rare formation that you almost never find on charts. You do find them, they're extremely rare, and they do not mean market bottoms. Almost always the diamond means that you are going down. Diamonds mean continuation on the downside. So if that's the case, another bearish indication right here. You see the average was stuck below it. You see the upright head and shoulders. And now you see that we have a diamond. I'm going to blow this chart up for you just a little closer. Let's get a little closer look at this chart. Okay, traders, same chart. Again, look at that diamond. But don't get fooled. Okay, if this is a bearish formation, and this is a bearish formation, the diamond, do your homework on the diamond, traders. You'll see what I'm talking about. And if this is bearish because we're below that average, well, watch out. Look what else we have going on here. This is actually a flag, a bear flag. Do you see it, traders? Forget about the diamond for a moment. Inside the diamond is a bear flag. Another bearish formation. The news is bearish. The technicals are bearish. You know, I don't see where all the buying is going to come from. But of course, if we get above this average, I will certainly take another look at this. The average comes in somewhere in the mid-880s, traders, the mid-880s. Somewhere in there, we're going to spot and see if this average gets violated. Now, when you violate a good average, you need 2 settlements above that average. 1, 2. If you don't settle both days above the average, it will become a failure. That's how you know if an average is good. If it gets above it for 2 solid days and settles above it, then the likelihood is you could get a rally. So let's continue to look at charts before we go any further on that one. All right, traders, this is the Dow Jones Industrial Average Daily Bar. Same average. Look at the respect paid, traders, once again, all over the map. Every time it gets near this average, it breaks back down. We're near the average now. What should make this thing rally? The good news? I don't think so. Yes, of course, you have the Santa Claus rally, the famed Santa Claus rally. And sure, it could show up because why? Because the specs are at the helm again. Beam me up, Scotty. They're going to go nuts. They always do. But it doesn't mean they're going to get it above the average. Let's see what happens. This average has had so much respect paid to it, I don't see why it won't continue to get that respect paid. So you see an S&P and you see the Dow Jones Industrial. Let's look at a few more charts here. Traders, this is the same chart again, the Dow Jones Industrial Average. And just to show you how much resistance technically is above this market, of course, you know that you see we have the average, right? Boom, boom, boom. But look what you have here. You have this huge, huge apex. We are below the bottom line of the apex. We are in the diamond formation, or I should say just, but basically stuck its head above the diamond formation. That would be here. So you have the diamond formation, you're below resistance, you're below an average. I don't know, traders, that's not bullish. Indicators are mixed, they're not pointing up or down. A good indication that specs are in control right now. So there is really no case for a major rally here except for the dubbed Santa Claus rally. I almost got fooled like the rest of you. I'm human, right? I have emotions. When I first looked at the charts, first glance, I thought, wow, we're getting ready to break out. The more homework I did, the more reason I found to think do not fall in love with any upside here. Let's look at more charts. This isn't over yet. Okay, traders, now we are looking at the FTSE, the Financial Times Stock Exchange. Okay, for you London traders, let's take a look at what's going on here. Look at the size of the apex that we're in now, right here, right? You see it well defined? You know where the market settled? Right down here, below that apex on Friday for the FTSE. Then you have this major resistance right here. If we got above that apex, you got to deal with that. That doesn't come in much higher. That's 50 points, 100 points higher than where we are now. Maybe 200 points, who knows? These days, that's not a big move. So you have major resistance up here. You see that we're in an apex. We're about to break out of the apex, and it came down and broke out to the downside on Friday. Granted, the U.S. went up, but the FTSE went down. So let's see what that means. Remember, traders, you also have this head and shoulders right here, and that has not gone away. That's a good, solid head and shoulders. More reason to think don't get happy for the upside, right? So I showed you a U.S. market. Now I'm showing you a London market. Let's continue looking around the globe here. Okay, traders, once again, the DAX with the Omni Proprietary Moving Average. This is not our usual one, which you usually will see a different color. This one is a new one that I have just debuted this week. And look at the respect being paid to this average all the way through this move. Tries to get up to the average here and fails. Tries to get up here and fails. Tries to get up here and fails. We are right here, right now in the DAX, traders. For you German traders, like the FTSE, you are below the apex formation right now. You settled down here. That is not bullish, traders. Then take the resistance line from the top and look where it comes in, right across the top of the apex. Right there. It's mirrored with the apex. So this is not bullish either. I'm telling you, I went around looking for reasons to try to tell you traders to get long today. I couldn't find any. Yes, it could still happen, but that would only be because the specs made it happen, because technicals are telling you if it pops a little, it's only going to be a little pop. Don't fall in love with it. So now you've seen the DAX, you've seen the FTSE, you've seen the Dow, you've seen the S&P. Let's go look a little deeper here. Okay, traders, now we are in Asia. We're looking at the Nikkei. Here we go, the Japanese market. Look once again at the respect paid to the Omni's Proprietary Moving Average. Boom, boom, boom. Anytime it gets near it, here once again, 4 times right here. Every time it gets near it, it goes back down. And then once again, look at this pretty little apex giving us the resistance and the spot to break down from. You need to clearly get above both the average and the resistance before you could even consider a buy. Again, how many jobs do you think got created in Japan this week or this year? How many got created in Germany? If you read the papers about Germany, they're in trouble right now. I read it over the weekend. How many jobs got created in London? Well, we know that they're in trouble. How many got created in the U.S.? Probably lost 650,000 this month when they revised the figures. How could this go up? How could you think up, traders? I mean, come on. I don't care what the street thinks. I don't care about the Santa Claus rally. I am going to sell rallies unless we clearly get above these averages in all of the world's indices. Then I'll think about maybe buying through the next week or so. Until then, I am selling rallies. Now I'm going to take you to an even much larger, broad view, a bird's eye view of what's going on in these markets, traders. Traders, we are looking at the Dow Jones Transportation Average monthly bar chart. This is the original Omni Proprietary Moving Average, the one I've been showing you for the last almost 18 months now. Look at the respect that the market had paid every time it got near it. The market always rallied when it got near that average. Until here, and we broke it and broke severely down to where we are now. We're trading right here. Okay, this is the 200 bar moving average. It did bounce off that, the monthly, but the important thing is we are finally below the Omni Proprietary Moving Average on a monthly, and that is not a bullish signal. Now wait until you see the next chart with the Omni Proprietary on a monthly. Back to you German traders, the Omni Proprietary Moving Average on the monthly bar, the DAX, the German DAX. The last time we got below the Omni Proprietary Moving Average was here in 2002. The price was 46.71. You know where it went? Down to 21.51. It halved itself. When it got below the average, it dropped half its value. Look where we are now, traders. Then it got above, and look what happened when it got above the average, right? It's a great average to use. When it got below, it did this. When it got below, it did, above, it did that. Now, look where we are. We're here. Boom. We're down here. The average is up here. This market is ready for another leg down. So if you get some silly Santa Claus rally, remember what's coming after it. There has to be another wave of downside coming. Let's go talk now, traders. Well, you see those charts, traders? I mean, come on. What do those charts tell you? Don't fall in love with the upside. I don't care what Santa Claus brings in his little sack. I am not falling for it. If we get above those averages and we get a couple of weeks up, maybe we'll play both sides, a little buy, a little sell, because when specs are in control of the market, you really don't have another choice. You're going to have to take both ends. So we'll see if we get above the Omni proprietary average in all those charts. Maybe we'll take a few buys this month because it's a wacky month. But I am telling you again, don't fall in love with the upside here. As much as emotionally driven it looks like it wants to go, the technicals are not calling for it. Be careful, traders. Please do your homework. Pull up the charts I showed you in this video and tell me if you don't find the same sort of things that I have found, because I'm sure you will. I'm not tweaking indicators. I'm not tweaking averages. I don't play with the charts. I use the indicators right out of the box, the averages right out of the box, because that's the smartest way to use them. If you're tweaking your parameters and you come up with some stuff no one else in the world uses, well, you know what? You're all on your own, and it's probably not going to be a self-fulfilling prophecy, which is what most of these indicators and charts are. Because so many people use the common ones, they become self-fulfilling prophecies. So stop trying to figure out some crazy systems on your own. Look, the people who invented stochastics and moving averages, Wilder, all these guys, right? They did all the homework, spent all the money that needed to be spent to come up with parameters that seem to work well. Use their parameters. Do yourselves a favor. That's a really good tip here from me. All right, traders. So, after looking at those charts, I decided to say I'm not calling for any buys anywhere till the charts tell me where they're going. I am not falling in love with the upside, and I'm paying close attention to that Omni average. All right, traders, if you'd like to learn how to look at analysis and do your homework like the homework I just showed you, come on down to the Omni Trading Academy. It's www.livewithoscar.com, and allow us to teach you how to be a better analyst. I am telling you, traders, I do this every morning, every evening, and I sleep, eat, drink, and think charts. That's all I do, and have been since I'm 18 years old. I am really, really well versed in looking at charts. Do I get it right all the time? Well, I can tell you this, on Thursday night for Friday, I gave my OmniX, I put it right out on the web for an Omni trade recommendation. I gave them the highs and the lows. I told them we're going to be selling it in the 70s. We expect it to drop all the way down to 817. The market went all the way down to 817 and went all the way up and hit my sell level, and I lost money on Friday. I fumbled the ball, traders. It happens to anybody. So the Omni came out with the exact high and lows, and I fumbled the ball. My apologies to you, OmniX. I don't know how that happened, but it did. I'm here. You can beat me up. Throw your stuff at the screen right now. I understand. But hey, keep your dukes up for Sunday night, because you know how this works, right? Got to keep your dukes up at all times. So look, anybody can come up with a good rec and still turn themselves upside down. So you got to be careful. Not only do you have to have your trading plan, you have to act it out perfectly, and which I try to do every single trading day of my life. But hey, we're all human. Anybody can get caught up, so be careful in these markets, especially now with the specs in control for December. You're going to need to be really careful with what you do and how you act out your plans. All right, traders, give me a call anytime, day or night, 702-629-4755. I really hope these weekend webinars are helping you. I hope all these videos help you. In fact, I think, what are we up to now, Mike? How many videos? We have so many videos, I'm losing count. How many videos do we have on YouTube?
I think this is going to be 389.
We have 389 videos like this on YouTube. You can go see them at www.youtube.com/futuresanalysts. Then we have almost 90 classes that are filmed and sitting in the library for you. It's called
Video on Demand.
Video Omni on Demand. We have about 90 classes where I hold interactive classes that are much more comprehensive than the stuff I show you in these videos. They are at my site. They are there for our VIP members and our premium room members to view. They are there for you members to view. If you are less than premium, you can still view, but there is a charge. Go look. There are also many free classes that are involved, that are part of that library. Some of them I just throw out there for free to help you traders, and you know I do lots for free to help all of you traders. It is what we're here for. We are here to help you traders, and my arms are open, traders. I promise you, if you come to my site, I'll do everything I can to help you with the mentality behind being a much better trader and the technical analysis to use with that mentality to hopefully get in and out of these markets correctly. All right, traders. You know, these markets are getting ready to open. It's Sunday mid-morning. I want to get out there and do more studying. So I will see you at the site, live in my chat rooms on camera. Make sure you come on down. And I guess we're out of here, right? Are we done? I'm done. I don't want to talk about anything else, so I'm getting out of here. Traders, say this to yourselves every morning, every afternoon, every evening, because it'll help you keep your emotions out of trading. And you know what that is? Stops are in. Emotions are out.
Futures trading is risky and can cause substantial financial loss. We do not claim or guarantee that you will profit from the information provided. That being said, I am a 24-year seasoned trader on and off the floors. This is how I've made my living for many, many years. Good luck trading.